Good morning or afternoon, depending on where you are. Still snowing out here in the Seattle area, even more so than yesterday. But hey, we have power, so we can continue. Today, we're going to be talking about collection financial standards for individuals and the use of Form 433A in particular. For those of you that have not attended one of our live presentations before, we here at Tax Resolution Academy, we try to do these a little bit different. We try to provide you with hands-on, pragmatic information that you can go forth and utilize in your practice. So we are going to talk about application today of the Collection Financial Standards, as well as do a little bit of a hands-on exercise to show you how to apply those in a collection scenario. I will be sending out certificates of completion. I'll probably actually do it all today. As a reminder, to receive credit, you have to stay logged in for at least 50 minutes and you have to answer at least 3 polling questions per hour. And we will be here for 2 hours today. Unfortunately, here on this new platform, I have absolutely no clue what it looks like on your end. This is my first time using this platform as a host, but somewhere on your end, there should be a handouts panel, and you should be able to see the handouts, which include the exercise as well as the slides from today. Do welcome and encourage your questions and comments. However, do bear in mind that we need to stay on topic and we cannot address specific client issues. So we are not here to discuss your specific client matters. That is not what CPE is for. We'll do the Q&A portion at the very end of the class with whatever time we have left. I'll respond to as many questions as I can during that Q&A section, but I guarantee you that we will not get to all the questions. There simply won't be enough time with all the stuff that we have to cover. Also, bear in mind that this is a basic level class. This is intended to provide you with foundational information in regards to the collection financial standards to help you work 1040 cases. So anything that is beyond the scope of that, we are not going to delve into. For those of you that are not familiar with who I am, my name is Jason Bowman. I am an EA specializing exclusively in IRS collections representation. I proudly declare that I am grossly incompetent to prepare the vast majority of tax returns. I don't do tax prep. I don't have, I've worked a couple tax seasons, but I don't have much of a tax prep background. And so that is not my forte. I am collections representation only. I've written about 10 books now, including the Amazon bestseller Tax Resolution Secrets, which is a consumer guide. It is not a professional guide. It is a consumer guide. It was a great lead generator for me back when I published that several years ago. I'm also the author of Tax Resolution Systems, which is a professional guide that was formerly published by CPA Trendlines. Now you can pick it up on Amazon. My claim to fame, if you want to call it that, is that I built a boutique tax practice from 0 to 35,000 a month in just 10 months. After growing an employer's firm from $750,000 a year to $3.2 million a year in just 17 months. Founder of TaxMarketingHQ.com, Tax Resolution Academy, Prolera, which is a Seattle tech startup, et cetera, et cetera. So I'm going to adjust the slides real quick because I just realized that's going to become very annoying with the automatic timings. There we go. So that's a little bit about me. So let us delve right into things here. So the purpose of our time together today is I want you to leave here with a better understanding of the purpose and application of the IRS Collection Financial Standards. If you've never seen these before, you're not familiar with them, then today will hopefully be insightful for you. We're going to walk through each individual expense category and talk about how to apply them. We'll then delve into the Form 433A in detail, and then in particular, we will walk through the most important section of the Form 433A, which is Section 5, the Income and Expense Table. So before we get too far into the weeds, let me put up our first polling question. So how many Forms 433 have you prepared this year so far? We're about 2 weeks into the new year, and I'm curious how many of you have prepared some for 33s. So I'll leave this up for about 10 more seconds. Remember, you must answer at least 3 polling questions per hour. What you answer doesn't matter, but you have to at least answer in order to receive continuing education credit. All right, closing the poll in 3, 2, 1. All right. So about half of you haven't completed any at all. There's 5 of you that are at the 5+ mark. So we got some folks here. Congrats that are definitely doing some resolution work. So glad to see that. All right, so let's talk about the Collection Financial Standards from a big picture. What is the fundamental purpose of the Collection Financial Standards? Why do they exist? Why does the IRS update them every March? You know, why do they exist? Well, they exist for one reason and one reason only, and that is to determine a taxpayer's ability to repay their tax liability. That is the entire purpose of the Collection Financial Standards. The IRS applies the Collection Financial Standards to everybody's financial situation with an individual liability in order to determine how much blood they can squeeze out of that particular turnip. Okay, that is the entire purpose of the standards. The scope of the standards is very important to understand as well. The standards differentiate between necessary and unnecessary living expenses. And of course, that is necessary and unnecessary from the perspective of the IRS. Your opinion about what is necessary or unnecessary may differ. Your client's expectation of what is a necessary or unnecessary living expense will most assuredly differ, especially when you start working with clients that are upper income, because of the fact that the Collection Financial Standards are designed entirely around a middle-class lifestyle. The Collection Financial Standards nationwide and the local standard components that we'll talk about, they are the sheer definition of the median, the very middle of a lifestyle here in the United States. That is what the standards are defined as. These standards are technically supposed to be reviewed quarterly, although in the dozen years I've been in this industry, I have never actually seen them updated quarterly. They are actually updated annually, and those updates are usually posted at the end of March of each year. So the numbers that we're going to be talking about today, these are the standards that were updated as of March 2019. The new standards will be released in March of 2020. Okay, at which time, if this is, if you're watching this later as an archived on demand webinar, all the information will be the same. It's just that the numbers will be different. That will be the only difference between what we're presenting live today versus what will be in the recording. Now, it is possible to go beyond what the standards are allowing. So because of the fact that the standards are intended to cover basic living expenses, the service understands that there are unique situations that can arise in people's lives. And in those situations, the IRS may allow for actual expenses if there are extenuating circumstances. And one of the things that you have to understand, after you get a basic understanding of these standards that we're talking about today, as you further your education in this regards, is you'll need to learn about conditional expenses. Conditional expenses are they're variances from the expense limits that we're going to be talking about today, or that are outside the scope of the categories that we're going to be talking about today. And understanding those conditional expenses, how to apply them, it is a way to take your representation, basically, of your clients to a whole different level, so to speak. So we will talk a little bit about some conditional expenses as we go through the expense categories, but understand that there's a whole other 2-hour conversation that we normally have in our live face-to-face boot camps about conditional expenses as well, that we're not going to get into as much of the weeds on here today. But understand that is out there. If you really, really want to go down this rabbit hole, I highly recommend that you read the Internal Revenue Manual Financial Analysis Handbook. If you just do a Google search for IRM Part 5 Financial Analysis Handbook, it should be the first link on Google, and go read that. It's very educational, okay, in understanding how the IRS does that. I have a separate 3-webinar series, a total of 6 hours that I do that delves into the Financial Analysis Handbook. I usually present that only once a year. And so if you get a chance to attend that, I'd obviously recommend it. Now, another thing that you're going to come across is taxpayers that are living significantly beyond the standards. So one of the challenges with applying the Collection Financial Standards is that they define basically what the IRS will allow you to spend to live. And for people that are not paying their income taxes, their personal income taxes, a lot of them are using that money that they should be using to pay their taxes. They're using that money to support a lifestyle that they really shouldn't be able to afford. And so because of that, they may simply not have anything that they can cut back on immediately. And the IRS is going to say anything above and beyond the Collection Financial Standards, we want that money as a monthly payment on an installment agreement. The IRS expects that money. That's the whole purpose of what we're doing here, in case you didn't realize that. And so some taxpayers are going to have to make some uncomfortable choices under your guidance in order to free up that money in terms of its actual availability. Okay? So there is something called the 1-year rule. And the 1-year rule is covered in the installment agreement portion of the IRM. And what it is it is a rule. The IRS will give the taxpayer a de facto non-collectible status for up to 12 months in order to give them time to reduce their lifestyle cost so that they can pay their tax liability, okay, so that they can free up money. And your job during that time is to push and guide your client to getting rid of toys that they really shouldn't afford, boats, planes, RVs, etc. Downsize to a smaller home in order to fall within the housing guidelines. Get rid of the four Mercedes Benzes that are sitting in the driveway, and move to a Toyota Corolla or Honda Accord. Okay, that becomes part of your job. That becomes part of what you get paid for, especially again for high income tax debtors that you are going to put into this lifestyle adjustment period, aka the 1 year rule. If you weren't aware that this 1 year rule existed, now you do, and it is something that you can and should take advantage of. Now, there are certain expenses that are never allowed, and I'm sitting here saying never while doing the air quote thing with my hands. Okay, because again, sometimes there are exceptions. Okay, those conditional expenses, but in general, most of the time there are certain expenses that are never allowed. So, for example, private school tuition. In general, the IRS does not care if parents insist on their child going to a religious school or to a private school. The IRS's stance is, well, we all pay taxes, and that funds a perfectly fine public education system, so it's there. Therefore, private school, not an issue. Now, can you get private school tuition approved as a conditional expense? Sometimes, yes. Okay. The places where we most often see this is if a child is in a public school system, the child is a special needs child, and that school system simply does not have the programs to accommodate that child's special needs. Sometimes we can make a argument for private school. Higher education tuition, again, K-12 is guaranteed in this country. College education, that is a privilege. It is not a right in the United States. Tithing to church, charitable contributions, retirement contributions, those things are all also optional and a privilege. Generally, the IRS does not allow payments on unsecured debts. So a lot of people will have issue with this in relation to their credit cards. Okay. Now, back in 2012, with the second phase of the Fresh Start program, the IRS did temporarily allow minimum credit card payments and minimum student loan payments to be calculated separately in the minimum offer amount calculation for an offer and compromise. However, for any of you that have looked at the offer and compromise Form 433 in 2019 or later, you'll notice that those line items are gone. Okay, that is no longer part of the offer and compromise calculation allowance. Unsecured debts are technically supposed to be included in the food, clothing, and miscellaneous expense category that we're going to talk about here in a minute. So in general, these are the types of expense categories that a lot of your clients may have. And they are going to moan, groan, gripe, and complain left and right about these necessary expenses not being allowed in the IRS calculation. Okay, but the IRS is going to say, we don't care if you can't make your 401k contribution. We want our, pound of flesh from what you owe us from last year. Okay, IRS is going to say, we don't care if you, if your daughter is about to start college at Harvard and have a great life ahead of her because of that. We don't care. That is not an allowable expense. Okay. I have gotten college tuition through as a conditional expense one time in my entire career, one time and one time only, and it was very difficult. I'm not going to go into the story, but it was very, very difficult. So some of these things are not hard and fast rules, but understand that in the vast majority of situations, you're not going to get these types of expenses allowed. And that takes us to our next polling question. How many tax resolution cases did you work on in 2019? I'm starting to get the feeling that there's a lag in this particular software system. I don't think it's instantaneous the way GoToWebinar was. All right, 10 more seconds on the polling question. 4, 3, 2, 1. See, a little over half of you worked 0 to 5. All right, so you guys aren't doing as much tax resolution work as you possibly could be. So definitely want to encourage you to do more of it. All right, let us discuss the expense categories in detail. We are going to start with the first one called the lump sum national standard. The lump sum national standard, again, keep in mind the numbers we're about to talk about. These are from March of 2019. They will update again in March of 2020. This expense category does include several defined expense items. They're all lumped together. But then it's also the catch-all, okay, where other expenses that are not generally allowed are theoretically supposed to be lumped together. So this standard, this expense item includes food, clothing, housekeeping supplies, stuff like soap, shampoo, deodorant, all that fun stuff. And again, it's also that miscellaneous category. The miscellaneous is for that thing, those expenses that we all incur, but that the IRS doesn't see fit to break out individually. So this might include your gym membership. This includes school supplies for the kids. This includes those minimum credit card payments. Okay. The thing that you have to understand about this particular standard, okay, this specific standard, is that the IRS has one number. It is one number for the entire country. There is no location-specific variability to this, okay? All of us, whether you live in Cheyenne, Wyoming, or Manhattan, New York, it is the same dollar amount, okay? And also, the IRS allows you to claim this entire expense regardless of what you actually spend, okay? So some people look at the dollar amount and they think it is ridiculously high. Other people look at it and think it is ridiculously low. Okay, so everyone is going to have a different opinion about whether it's high, whether it's low, but the number is what the number is. So what is the number? Well, if you go to the IRS website and you look at the national standards, this is what you will find for the food, clothing, and miscellaneous standard. Okay. For one person, it is $727 per month. And the IRS breaks it out, as you can see here in the table, they break it out into these different sub-items. But what actually goes on the Form 433 and what your client is allowed to claim is the lump sum amount. The actual individual subcategories where this big number comes from, they're actually immaterial. They don't matter, okay? A single person like me, I can claim the full $727 a month, and the IRS cannot question me on, they can't ask me to validate that I'm actually spending that much, okay? Now, if I'm trying to prove that I should have an allowance, a conditional expense that exceeds the $727 a month, then I'm going to have to prove it. So, for example, if I have a medical condition that requires a special diet that is an expensive diet, then I'm going to have to provide, medical records to that effect. And I'm going to have to come up with, 3 months worth of grocery receipts showing that this is what I actually spent, okay, in order to be allowed a higher amount. But if it's less than or up to the $727, then you can put on the Form 433A the entire $727. For 2 people, it's $1,288. For 3 people, it's $1,446. And for 4 people in a household, it is $1,786. And then for each additional person beyond 4, you can add $420 per month. Now, some people will say, especially if they have, a teenager in the house that's, eating them out of house and home as the kid grows, they're going to say that $420 a month is completely inadequate. There are other people in other parts of the country probably that are going to say $420. They wish that they had that amount of money coming in to support, each additional person in their household. They'd be ecstatic if they had that coming in. So again, this is going to vary based on your client's lifestyle and geographical location. But these are nationwide numbers. These do not change based on locality. Okay, so that is the lump sum national standard for food, clothing, and miscellaneous items. We will come back to talk more about that as we continue on here today. Next polling question, a fun one. Remember, there is no requirement that polling questions have anything whatsoever to do with the actual topic at hand. And I have fun taking advantage of that. So if you could combine a CPE seminar with a family vacation, where would you want to go? A Hawaiian cruise, an Alaskan cruise, a European river cruise, a Caribbean cruise? I should have added a 5th option here. I hate cruises. Wow, you guys are pretty much evenly split across the board. Alaska is barely winning. Barely. Oh, Europe just pulled ahead. Hawaii and Europe are in a dead heat. All right, 10 more seconds on the polling question here. And a 4, and a 3, and a 2, and a 1. All right, so you guys want to go all over the place. That works. All right, now let's talk about healthcare. So there are 2 components of the healthcare expense standard that we have to talk about. So a few years ago, the Congress critters decided that we all needed to have health insurance. And they passed this little law called the Patient Protection and Affordable Care Act. And so because of that law, the IRS says that we can claim all of our health insurance premiums. And by the way, the Affordable Care Act doesn't limit how high our insurance premiums can be. It doesn't, say, oh, everybody has to be on just a bronze plan. Okay, if we want to be on a gold plan, we can be on a gold plan. And the IRS cannot say, oh no, you should only be on a bronze plan. Okay, that's cheaper. And by the way, that little fact will be something that we can play with later on. So tuck that away in your brain as an additional potential thing we can have some fun with later on. So that's first of all, is your actual health insurance premiums. The other side of this is the out-of-pocket healthcare cost, out-of-pocket. So what the IRS says is, okay, everybody has different healthcare needs, right? And so people are going to have different circumstances in their lives. So we are going to be okay with everybody claiming their actual out-of-pocket healthcare cost. So whatever your client is paying every month for co-pays, prescriptions, anything of that nature, then you can claim those actual out-of-pocket costs without a cap. Okay, as long as you can prove that the expense is paid and that it is necessary, then the similar rules as for the deductibility, on a Schedule A for a medical expense apply here. Basically, if it's not something that's going to be a deductible medical expense, it's not going to fly on the collection side either. So, for example, the gym membership isn't going to count. Okay, so it's either your actual out-of-pocket costs, or if the taxpayer's out-of-pocket healthcare costs are low, then there is a standardized amount, and this amount changes year to year. It was amusing a few years ago when it went down for some weird reason. So for a taxpayer that is under the age of 65, it is $55 a month. And this is an allowable expense regardless of what the person actually spends, even if they spend zero. Okay. For a taxpayer that is 65 and older, then the allowable amount is $114 per month. So $114 a month. And again, these numbers will change here in 3 months. Those are the current amounts. Now, then we get into the transportation standards. And there are 3 things we're going to talk about here with transportation. There's public transit, car ownership, and then car operating cost. Okay. So under the transportation standards, a taxpayer is allowed a monthly expense allowance for either public transit or a vehicle, but not both. Okay, so one or the other. If the taxpayer does not have an ownership cost associated with their vehicle, meaning that they own their car free and clear, there's no lease payment, there's no monthly loan payment, then they do not get an allowance for the ownership cost, only the operating cost. So ownership cost is the monthly allowance for a lease payment or loan payment. Operating cost is things like gas, insurance, and maintenance. They are 2 separate standards. Okay. And what's interesting about this is that the ownership standard is a fixed nationwide amount. It does not have any regional variation. Whereas the operating cost allowance will vary heavily by region. So just to fill in some numbers here, the current national standard for the monthly public transit allowance is $217. Okay, $217. And this is a standard that the taxpayer is allowed to claim if they don't own a car. Okay, if they don't own a car, then the $217 a month for the entire household can be claimed without documentation of the actual amount that they spend. Okay, so $217 there. But what if they have a car? Well, if the taxpayer has a car, there are some additional rules. One, there is a limit of 2 cars in the household. Okay, so if there are 3 cars in the household, too bad, so sad. The rules only allow credit for 2. Also, the dollar amount that you see here on the screen for the current standards, this is actually becomes a lesser of scenario. The taxpayer is not allowed to claim $508 a month for a car payment if their car payment is actually less. This is a cap. Okay, so if the taxpayer's car payment is, say, $325 a month, and they have 1 car, they're allowed to claim an ownership cost of $325 a month, not the $508. Okay, now what if their lease payment is $975 a month for 1 car? Well, they're allowed $508. They're not allowed the full $975. The $508 per car is a cap on the monthly loan or lease payment. Okay, so this is unlike the lump sum national standard for food, clothing, miscellaneous, and the out-of-pocket healthcare standard, or the public transit standard, where it doesn't matter what they actually spend, they get the full amount. Okay, this one's different. Okay, it is a lesser of standard. And if you're taking notes, it's very important to make that distinction here now that we're talking about transportation. Okay, so if the family has 1 car, again, maximum of $508. If they have 2 cars in the household, $1,016. If there are 3 cars in the household, they're stuck at 2. Unless you can make a conditional expense argument for a 3rd car. Now, if that 3rd car is necessary in order to, let's say that the family has a special needs child that's in a wheelchair, and they have their 2 cars for commuting to work, but then they also have an accessible van in order to get that child around. That would be a potentially allowable expense as a conditional. Okay, but if it's just, say, the 17-year-old teenager's car that he drives around, that's not going to be allowable. If it's just a 3rd car that just kind of sits there and doesn't get used very much, not going to be allowed. Collector car, not going to be allowed. Okay. When it comes to conditional expenses, if you get nothing else out of this webinar, this is what I want you to get. When it comes to conditional expenses, the key is that you can usually get a conditional expense approved if you can demonstrate that the expense is incurred either for the production of income or for the health and welfare of the family. Then you can often get that conditional expense approved. You'll notice that the examples that I'm giving you are about the health and welfare of the family, aka it's for the children. Okay, if you can demonstrate that a conditional expense is for the health and welfare of the family, especially for the kids, then that conditional expense can often be granted. If it is for the production of income, the IRS likes people being out there producing income. Because if they're producing income, then they are producing, theoretically anyway, producing tax revenue to the government. Okay, so they like both of those scenarios. So those are the two things I always want you to keep in mind when it comes to these conditional expenses: health and welfare of the family, or for the production of income. So let's say that a family with two wage earners, they have two cars, that they have payments, but then they go buy a third car, and maybe that third vehicle is a van, so that one of the wage earners can do like an airport shuttle ride sharing service sort of thing in the evenings and on the weekends, but they need that van. Well, that's production of income. Okay, we'll probably be able to get that approved as a conditional expense. Okay, but if it's just a third car that they have for fun, it ain't going to happen. All right, so that is where so kind of some gotchas, if you will, on the car ownership. Now, separate from the car ownership are the operating costs. So insurance, gasoline, oil changes, regular maintenance, all those fun things. Those are regional. Okay, and you'll notice here that the regions have like sub regions. What the IRS does is they look at the cost of insurance and gas, primarily is what they look at, in metropolitan areas, and then within a geographical region of the country, but outside of the major metropolitan area. And they will assign different allowable operating costs for those major metro areas that are different from the region as a whole. So, for example, in the Northeast, there is a cap of $237 per car. Okay, and by the way, that is a cap. The taxpayer has to show what their actual expenses are, and if their actual expenses are lower, theoretically, they are only allowed the lower amount, but I'll have a further comment on that here in a moment. Okay, so this is a lesser of expense. However, in certain metropolitan areas, the IRS says that it's either cheaper or much more expensive to drive a car than it is in the Northeast as a whole. So in the Boston metro area, they're saying it's cheaper. In the New York City metropolitan area, they're saying it's much more expensive. Okay, and in the Philadelphia metro area, they're saying it's slightly more expensive. Now, I don't know if we have anybody here from Boston that's actually on the webinar, but I'm sure that but if there was, I'm sure that somebody would argue that the cost of insurance and gas and operating a vehicle in the city of Boston is not really less than, say, elsewhere in the Northeast, such as Portland, Maine, or somewhere in Vermont. Okay, but this is what the IRS says based on the data analysis that they do. So it is important for you to know what geographical region your client lives in, so that you can know the proper cap to apply. So how do we know what makes up, quote unquote, Boston? What is Boston? Heck, what is the Northeast region? Well, the IRS provides us a nice table of what these are. So the Northeast census region includes Maine, New Hampshire, Vermont, Massachusetts, Rhode Island, Connecticut, Pennsylvania, New York, and New Jersey. And so if your taxpayer is in one of these states, but they are not in one of these big metropolitan areas, then they're capped at the $237 per month per car. Well, what makes up Boston? Well, Boston is defined as these counties in Massachusetts and these two counties in New Hampshire. So if your client lives in one of those counties, then they get basically penalized by $7 a month on their maximum allowable transportation operating costs. Okay, so this is available for every census region and the county definitions for each of the major metropolitan areas. So I'll give you another example here. It's local to me. So I'm in Kitsap County of Washington. So if I had clients here, they would not be subject to the Seattle special allowance, okay? Because that's only King, Pierce, and Snohomish counties. And so I would use the West region dollar amount of $205 per car, okay, instead of the higher Seattle allowance, okay? Now, a brief word on this before our next polling question. Under the Financial Analysis Handbook, okay, under the application of these standards, the vehicle operating cost standard is a lesser of standard, okay? Under the rules in the IRM, a taxpayer is only allowed to claim what they actually spend. They are not allowed to claim the full operating cost allowance without it being questioned, okay? It is actually it's even stated right here on the IRS webpage, okay, that contains these numbers. Now, when I was going through NTPI level 2, the instructor, a very well-known individual in our circles, argued with me on this. And I lost a lot of respect for that particular individual because of how adamant he was that no, this is the rules say that the standard is what it is. Okay, and he was wrong. But here's the thing about that. There are things that are stated in the IRM, but that are not but that are handled differently in actual practice out in the field. Okay. So I will tell you this, out of the 390 plus, tax resolution cases I worked in my career, I never had a revenue officer or an ACS representative ask me for substantiation on the operating cost numbers. Okay. I never, ever, ever had it questioned when I just put the cap. All right. So my recommendation to you as a pragmatic application here is to put down the cap. All right. Even if your client spends less. And if you ever have a revenue officer question you on that, please drop me an email because I want to know about it. I've been teaching these classes for like 5 years now, and I have never, ever, ever had a practitioner take me up on this and send me an example where it was questioned. Okay. But I want you to know that technically under the rules, this is a lesser of expense category. Okay. There is a big divide there between what happens in the field and what the regulations actually say. All right. And this is the only expense category, by the way, where that tends to hold true. All right. So, what if your taxpayer, your client, their expenses are higher than this? Again, that then becomes a conditional expense, and you're going to have to prove it, and you better have a good explanation of why the IRS should accept that. And that takes us, I believe, to our next polling question. I'm not sure how much I like this new platform. I know Dan didn't like it. It's definitely quirky. Over half of you are saying you're prepared for it. A quarter of you are saying you're completely unprepared for it. Another quarter of you are saying, meh. If you're set to retire within the next 10 years, you don't need to worry about it. If you have longer than that to go in your career, then you dang well better be worried about it. Closing the poll. All right. Now we're going to take a look at one of the most contentious of the collection financial standards. This is the one that more of your clients are going to complain about than any other, okay? And that is the local standard for housing and utilities. This collection financial standard covers rent or a mortgage payment, including taxes and insurance, covers maintenance, covers utility bills such as gas, electricity, water, garbage. It also covers home phone service. Apparently, some people still have one of those. It also covers cell phone, cable TV, and internet. If you read into this closely, you'll notice that, yes, in fact, the IRS considers your cell phone, cable television, and your internet service to be perfectly legitimate, allowable monthly expenses, okay? This gets into a very interesting conversation. We're not going to go down this rabbit hole, but it gets into a very interesting conversation when you are trying to put somebody into, when you're trying to get a levy released, okay? And the person has, very expensive, high speed, like 1 gig fiber internet. They've got the latest iPhone, with a $200 a month family plan. They have the $300 a month cable package with all the sports and movie channels and everything. Okay, those get into very interesting conversations when you're trying to get a levy released, because these collection financial standards obviously apply when you're trying to argue for a levy release based on financial hardship. Okay, that is another area where these are applied, by the way. It's interesting in those scenarios versus when we're just having like an installment agreement or offer and compromise conversation or CNC conversation like we're really having right now. I firmly believe that a cell phone and cable TV are not necessary living expenses, but there's millions of people that disagree with me on that, okay? So again, when you just tuck this away in the back of your mind, if you're ever doing a levy release situation for an individual, especially a wage garnishment release, their cell phone bill, their cable TV bill, their internet bill may come under question and under scrutiny. Okay, and it may be and it may look like a very different conversation than what we're talking about right now. The basis for the local housing standards comes from a variety of sources. There, obviously, the U.S. Census Bureau, they do the American Community Survey every year. That big privacy invasive survey they send to millions of people. Income data comes from the Bureau of Labor Statistics. And if you look at how this trends over the year, there are just oddball, weird upticks and downticks in the cost of living, according to the IRS, that don't necessarily align very well with reality on the ground. Okay, And so a lot of people, when these went down in 2016, I don't know of anybody that was saying that the cost of living in their local area went down. Okay, nobody was saying that. So sometimes these are wonky, but unfortunately they are what they are, and we all kind of have to live with them, including your clients. So these are numbers that you need to become very familiar with, and if you are focusing your practice in a geographical area, then you need to become very familiar with these numbers for your geographical area. If you are working with clients nationwide, like I did, or in a multi-state region, like I did with my trucking clients, then you're probably not going to be able to memorize every single county and every state. So I'll show you what this looks like. If you haven't been to these web pages, I recommend it. It's irs.gov/businesses/small business self-employed local standards. Okay, you could just if you just Google IRS Collection Financial Standards, you'll get here. Let's say Google is one of the most underutilized tax research tools that there is. Okay, so when you come to the local standards, you'll click on your state. Let's just take a look at Connecticut. And what you're going to see is a table with each county in the state listed alphabetically. And then across the top, the numbers for households of various size. Okay. So in Fairfield County, Connecticut, I have no idea where that is, but it is obviously a high cost of living area. Based on these charts here. And so in Fairfield County, Connecticut, the maximum allowable monthly expense for a single person, a household of one, is $2,552 for rent, gas, electricity, heating oil, cable TV, internet, whole 9 yards. Okay, 2552. Nicole says Fairfield County is outside of New York. Okay, that explains it. So 2552. Okay, now that I know it's close to New York City, I don't know that 2552. That may not get somebody very far if you're close to New York City. I don't know. I'm guessing it probably doesn't. In terms of like an apartment and, after you layer on all the utilities and everything. So this might be an example of one of these where it's just really, really low, okay? And your client might look at this and go, there is no way that I can live on $2,500 a month in Fairfield County, Connecticut. It's impossible, okay? I don't know for sure, but, a lot of people might say that. There's going to be other people that go, well, I mean, that's, more than what I actually spend. I only spend $1,800 a month for everything. Okay. And then you're great. The person that only spends $1,800 a month, guess what? They're only allowed the allowance for the $1,800 a month. They do not get to claim the $2,552. This is a lesser of standard. Lesser of. Okay, and this one, unlike the operating cost for a vehicle, this one is heavily enforced. All right. So for 2 people, it's $29.98. 3 people, 4 people, 5 people. Notice that there is no column for 6, 7, 8, 9. Okay. What if somebody has a bigger family? Is there a, for each additional person, add X dollars? No, there is not. Okay. So for a family of 6 or 7 or 8, they are capped out at the $3,579 a month for housing and utilities in this county, in this state. Why? Well, remember that $420 per month per person for the food, clothing, and miscellaneous? Well, theoretically, the slight increase in the water bill and the electric bill, and requirement, higher rent for the seventh bedroom or whatever, is theoretically incorporated into that $420 a month on the food, clothing, and miscellaneous standard. Okay, and so it doesn't need to be taken into consideration here. Okay, now I've worked with plenty of clients that had a large family. We're talking 6 to 10 kids, and this would be absolutely this is an absolutely ridiculous conversation to have with them. Okay, what do you mean? I've got 8 kids. I need like a 6-bedroom house. How do I can't get that for $3,500 a month. Are you kidding me? Okay. So here's what you do. Here is the conditional expense trick that I want you to remember for the housing utility standard. Okay, this is the writer downer. Pretty much everywhere in the country, there are state laws related to child protection. Okay, and those laws or regulations or pronouncements, if they don't have the force of law, it may be a state child welfare agency has the authority to promulgate regulations that stipulate these things. Okay, so it may not be codified in state statute, but every state that I know of has some sort of either law, regulation, or other official pronouncement that says certain things about the expected living conditions of children. There are usually restrictions on the number of children that can share a legal bedroom. There are usually limitations on children of opposite gender sharing a bedroom once there's a certain gap in age. Like they may say that it's inappropriate for a 15-year-old boy to share a bedroom with a 4-year-old girl. Okay, most states have those kind of rules in place. I have personally found the best place to get a simplified explanation of those is at a local foster care agency. So go to a foster care agency. A lot of them will have either a web page or a pamphlet or something like that that explains what these state rules are. You then take that to the IRS and you use that and say, well, under Connecticut, statute, blah, 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 we are required to have a minimum 5-bedroom house for our 7 children because of the age and gap and the gender mixture, etc. Okay, and you show the IRS, you show them rental listings, you show them apartment catalogs, etc., that show that it's impossible to find something like that for, say, less than $5,000 a month in rent. Okay, that is how you get that conditional expense proved. Okay, for a large family. Now, if we're talking a family of 2, so say just a married couple, and you're saying, no, I need my $5,000 a month house, it's not going to fly. All right. But if it's for, again, health and welfare of the family, aka it's for the children, okay, then you can make those conditional expense arguments. Okay, that is a good trick to have in your back pocket. So whatever part of the country you're operating in, if you are only working with local clients, I just recommend that you know what your numbers are for your local area. If you're working with clients nationwide, then you're just going to want to bookmark the page I showed you earlier. The housing standard is the single most commonly exceeded standard. It is the one that your clients are going to gripe about the most, okay? Because they're going to say it's unfair. It's impossible for me to find a house in my area for less than the standard. And you know what? That may be true. But also most counties have a spectrum. There's a continuum of high cost to low cost areas, even within a county. And so the expectation is that you need to move to closer to the median cost area. This is where the 1 year rule really comes into play. And you negotiate with your revenue officer or an ACS supervisor. You say, look, we want to apply the 1 year rule to do the 12-month lifestyle adjustment. That'll give us a few months to sell, the giant house and move into the smaller, mass-produced, builder quality home that's 2 miles away, but still within the same county. All right, that gives us time to get rid of the Ferrari F40 and downsize to a Toyota Corolla. That gives us time to decrease our insurance on the car because we don't need $10 million worth of liability coverage, for each driver. Things like that is what you're going to do during this 1 year period. Okay. Does this become difficult with your clients? Do you think this becomes awkward conversation territory? Absolutely. Okay. But this is the nature of collections representation. It's just the nature of choosing to pursue this line of work. You will become a financial counselor. It's just part of the territory. So next polling question is up on your screen. Under which collection financial standard category does food fall? Local housing and utilities, transportation, food, clothing, and other items, or out-of-pocket healthcare? What collection financial standard category does food fall under? It's probably the one with food in the name. All right, 5 more seconds on the polling question. 5, 4, 3, 2, 1. Ding, 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 ding. All right. So we have now gone through the major expense categories, and now we are going to delve into Form 433A. For those of you that have never, ever taken a look at Form 433A, it is available on the IRS website. It's also in the handout section here on the webinar platform. I recommend that you take a look at it. There's a lot of people that have done maybe a few tax resolution cases that were only ever assigned to ACS, the automated collection system, the 800-829-1040 call center. And so they've never seen the 433A because ACS doesn't use the A. ACS personnel, they use the Form 433F. Or as of last year, the brand new 433H form. But the ACS personnel, if you send them a 433A, their eyes are going to glaze over and they're not going to know what it's about. So why am I talking to you about the Form 433A? Because it's the long form. Okay. Same thing like when you're learning tax preparation, you don't learn how to prepare tax returns from the form, or back in the day, I guess, the Form EZ. You learn from the long form and then simplify down, or at least that's how I learned. I did not learn on the EZ and then go up. Okay. So the 433A, this is the form that you're going to use if you're talking to a revenue officer on a case that is assigned to the field. And then Seth, great question. What's the difference between the 433A and the 433A OIC? You're also going to use a version of the 433A when you're doing an offer and compromise. The difference between the two forms is that the offer and compromise version is expanded out even further in order to include the flow through calculation blocks to help you calculate the minimum offer amount. Okay. So another reason to study the 433A is because then it'll look familiar later on when you start learning about offer and compromise math. Okay. And if we were doing this in the normal, 2-day seminar setting, the class that we're doing right now would be the end of day one. And then offers and compromise would be right before lunch, on day two. And so they definitely flow from one to the other in terms of the class content. And I, for those of you that have noticed over the past few months, I am marching through the normal 2-day curriculum. So one of our next classes here in the next month or two will be that offer and compromise class, and we'll be going through the 433A OIC. Okay. So stay tuned for that. So the 433A, the long form, if you want to call it that, maybe I shouldn't use that term, but this is what is on there. Personal information up here. I'm not going to read every single thing on the form. I will say that even though we now live in the era of no personal exemptions, and so you may think, oh, the dependents doesn't matter. Okay, well, you still want to list out the dependents because that's what the IRS is going to use in order to determine the household size and thus the allowances on housing and utilities and food and clothing that they're going to give you based on the per person basis. Okay. This one tends to throw people for a loop. Driver's license number and state. Why on earth would they want to know driver's license number and state? Because we're doing this on a webinar, I can't just kind of tease the audience here and engage a reaction. But the reason that they want to do this is because in most states, vehicle title registration information is tied to your driver's license. And so the IRS uses driver's license information to check with your state DMV to look for vehicles and other items that you may own in that state. They're looking for undeclared assets is what they're doing. Okay. Employer information. The main thing that I want to talk about here is block 4D and 5D. Does employer allow contact at work? I have never, ever, ever bothered to ask a client that question. Simply check the no box. Okay. Assume it on behalf of your client. Okay. Last thing you want them dealing with is that. Okay. The other thing I want to say about this is that when you provide the employer information to the IRS of one of your clients, you are also giving the IRS, if they didn't already know, because of the address with the that's on the W-2 or whatnot. If the IRS doesn't already know where your client works, as soon as you fill this out and submit it, they're now going to know where to send the wage garnishment. Okay, so I want you to be aware of that. The IRS probably already has that information, but if your client has obtained new employment since their last W-2 was filed, this is updating the IRS's information on where that person works and where to send the wage garnishment to. All right, so be aware of the hidden meaning or the the other risks of providing information to the IRS. All right. And I will tell you, I have worked with plenty of clients where I simply okay, because I didn't want the IRS to know where my client was working. Okay. Sometimes you can get away with that. Sometimes you can't. Okay. It's all part of the playing the game. Okay. And it's part of what makes this kind of work different than just regular straight up compliance work. Okay. Information that you're providing and what the IRS can do with it. All right. So just something to think about. Section 3. So this was section 1 and 2. Section 3, we're going to spend a few minutes on here. Section 3 is other financial information. These are what I call the really dirty questions. All of these questions have implications for your taxpayer. Okay. The IRS wants to know if your client is a party to a lawsuit. Okay. Why? They want to know if there might potentially be a judgment coming against the taxpayer that is going to take precedent over the IRS's ability to collect money. They also want to know if your client might be coming into some money. Okay. If they are the plaintiff and they're going to win and they may all of a sudden have a bunch of money coming their way. The IRS wants to know about that. They want to know, have you ever filed bankruptcy? Why? Because they want to know if you can do it again. Okay. Contrary to popular belief, okay, personal income tax debts can be flushed in bankruptcy if the taxpayer meets a specific 3-prong test. Okay, we're not going to delve into that, it's beyond the scope. But if the taxpayer has not filed bankruptcy, they want to know if you can, or if you have in the past, they want to know how long it's been, because there's a waiting period to do it again. Okay, they want to know if that's an option for the taxpayer. In the past 10 years, has the taxpayer lived outside of the US for 6 months or longer? The reason that they want to know this is because if a taxpayer lives outside the US for longer than 6 months, after the 6-month mark, the CSED clock stops ticking. It is a tolling event that extends the amount of time that the IRS legally has to collect on the liability. Okay? And it helps them to calculate what those CSED dates are. Are you the beneficiary of a trust, estate, or life insurance policy? Or are you the trustee, fiduciary, or contributor of a trust? Basically, they want to know if you have access to money, if you have access to a place where you can hide assets. They want to probe those potentialities. Do you have a safe deposit box? Yes, those still exist, and people still have them. Safe deposit boxes are great places to hide securities, cash, small but high value items like diamonds and rubies and emeralds, things like that. Okay. In the past 10 years, have you transferred any assets for less than their fair value? This is a rabbit hole we could go down and spend 2 days on. So I got to be careful what I say here. But basically, if the IRS, if a taxpayer has something of value and they give it to somebody else, and if the IRS has any financial interest in that piece of property, then the IRS has, there are processes the IRS can go through to basically seize that asset and then sell it and get their interest out of it, okay? And this creates all kinds of fun legal complications for your client. All right. But the IRS wants to try to identify the potential for that. And yes, Nicole, yes, they would. As you can see, these questions are very they have a lot of nuance to them. Okay, so these are things that you have to ask your client, and in an ideal world, the answer will be no to all of them, but sometimes the answer will not be no. Okay, and you need to divulge what needs to be divulged, and also explain to your client that your client is signing this form under penalties of perjury. Okay, do not sign these yourself, by the way, as power of attorney. Your client signs these, and again, I can't tell you how many of these I have submitted that were not only partially filled out, but also not signed by anybody because the client did not want to sign the perjury statement. Okay, so that's a consideration as well. But these questions are particularly important for a lot of other reasons under the IRM and the IRC. Now, Section 4 of 433 are personal assets. Now, we're not going to spend much time going in depth on this. This is just going to be a real quick look at it. But basically anything of value. The IRS wants to know what the taxpayer possesses, what they have access to. They want to know everything down to the cash in the wallet, cash under the mattress. They want to know checking accounts, savings accounts, stocks, bonds, IRAs, 401ks, Coverdell's, 529s, 403bs, everything. Don't forget, a lot of people don't realize this, but retirement accounts, college savings accounts, the IRS can legally take that money, okay? Those are leviable assets under federal law. So the IRS can just swoop in and take it. They can also force the taxpayer to simply liquidate the account and turn the money over without going through the levy process. When you are looking at, and by the way, sometimes the resolution for the taxpayer is to drain the 401k, give the money to the IRS to pay off the tax debt. Sometimes that is the resolution. Okay. Sometimes that is the best option. Okay. When you're doing this, the IRS does allow the taxpayer to reduce the value by 10% to account for, obviously, the early withdrawal penalty. Okay. A lot of taxpayers also forget to put down the value of a business entity in which they have a financial interest. Think about this, think about your own practice, right? Do you ever really think about how much your practice is worth, what your business is worth? I know I don't. I'm sure a lot of you don't. Same thing with a lot of other self-employed people. Think about the guy with, that's a carpet cleaner. He's got one van, works just by himself. He probably doesn't even think about his business having a value, but it does. Okay. And yes, Jeff, it is very, very easy. And if you didn't know this, you will now. It is very easy to make many small businesses have a value of zero. Because if the taxpayer wasn't involved in the business wouldn't exist anymore. Therefore, it's worthless without that person, right? So technically, the market value is zero. But you still need to disclose that the taxpayer has a financial interest in that business. Over the past year, you probably already know this. But Coinbase, a United States, the largest US-based virtual currency exchange. They half won, half lost a lawsuit filed by the IRS against them. They had to turn over a bunch of records so that the IRS could send letters to, I think it was around 10,000 people in regards to undeclared virtual currency transactions. Okay, so this is an enforcement area. Commissioner Rettig has stated that there will be continued enforcement increases in this arena. It's something that collections now has to look at on the new version of the 433A. There's a block now for virtual currency. Okay, so this is like one of the. There's not a whole lot of change that happens in the collections world year to year, but this is one of the recent changes that you have to ask about now. Okay, is you have to ask your client if they own any, Ethereum, Litecoin, Bitcoin. Those are the common ones, but also don't forget to ask them if they invested in any ICOs, initial coin offerings, or token offerings. They're basically the same thing, but you have to ask your clients if you bought any virtual tokens, any cryptocurrency, any ICOs, anything like that. Those assets need to be declared. That takes us to another polling question. Yeah. Polling question. That was for you, Robert. So John owes Jerry $250 for that one night at the bar and is paying him back at the rate of $50 a month. How much of this will the IRS allow on a Form 433A? Is it A, all of it? Because nothing breaks bro code. B, a maximum of $25 a month for the personal loan category. Or C, whatever will fit under the lump sum national standard. Ten more seconds on the polling question. Closing the poll. By the way, the correct answer is C, whatever will fit under the lump sum national standard. The IRS does not recognize bro code. Continuing in Section 4, personal assets, the IRS is also going to want to know about available credit. Credit cards, lines of credit, HELOCs. This is something that a lot of practitioners don't think about, but it is something that you should consider when you're representing a tax debtor. And that is, depending upon the age of the tax debt, okay? Depending on the age of the tax debt and the specific circumstances. In case you're not aware, the failure to file penalty is 5% per month. Okay? The failure to pay penalty, 0.5% per month, both capping out at 25%. Okay. If we're talking about a business, those nasty failure to deposit penalties, up to 15% on payroll taxes. All right. If the taxpayer has not accumulated much or any of those failure to deposit, failure to pay, or failure to file penalties yet. Okay. For example, somebody who they paid, they had some withholding, made some estimated payments, etc. for 2019, but on April 15th of 2020, they're going to have a bill. Okay. Well, that return hasn't been filed yet. That bill has not started accruing yet. In those situations where those penalties haven't been racked up yet, it is often cheaper for the taxpayer to pay the tax bill with a credit card, a HELOC, a signature line of credit, whatever they can tap into. Okay, HELOC rates right now are at like 5 or 6%. There are a lot of credit cards out there where they can load up a credit card and then get a new credit card on a zero interest balance transfer option for like 18 months. There's still a lot of those offers out there. Okay. Even at 5 or 6% on a HELOC, for example, that is going to be cheaper than, say, a 5% per month failure to file penalty with a 25% cap. Okay. So when you are talking to your client about their available credit, and in particular, they have not maxed out those failure to file, failure to pay, failure to deposit penalties yet, take a look at whether or not you can load up their tax debt onto another creditor, where the interest rate is going to be far, far cheaper than those IRS penalties. I'm not even talking about the IRS interest rate. Okay, I'm talking about the IRS penalty rates. Okay, so that is another consideration. The IRS wants to know about those. The IRS would prefer that you load up debt elsewhere than with them. That's why they ask about these. Then there are obviously insurance products out there that have cash value, that if they're accessible, the IRS will expect the taxpayer to tap into those. If there is real estate in question, personal residence, investment property, vacation home, etc., the IRS is generally not in the business of seizing a primary residence. They only do it once or twice a year, and it requires a district court judge to sign off on it. But investment properties, vacation homes, the IRS can seize those administratively through the non-judicial process that we all know and love. And they do this, several hundred times a year. So if your client has, investment properties, vacation home with equity in them, the IRS expects you to attempt to tap into that equity, even in a personal residence. They expect you to tap into that equity, if at all possible, in order to pay the IRS. And if it's anything but a personal residence, the IRS can seize those assets. Okay. And so they want you to disclose those. On the vehicle side, normally we only think about cars and trucks, but the IRS is also concerned about other things with wheels, skis, engines, runners, tracks, okay, propellers. They want to know about motorcycles, aircraft, ATVs, trailers, be they like utility trailers or RVs, personal watercraft, all kinds of things that we may not think of, but they have value. Okay. And if you don't disclose these, the IRS can fine them, because a lot of these things have titles. A lot of them have registrations that the IRS can, through their financial investigation, eventually uncover. And so you want to, in a full financial investigation, you got to disclose all that. Other assets. The main thing I'm going to say about this will be twofold. One, your client, people accumulate material possessions that might have value to them, but that you may not think of as having any value. Because people value different things differently. I always pick on comic books as the example. I'm not into comic books. I don't understand the fascination with them. I know absolutely nothing about the DC and Marvel universes. I don't know who all the characters are in all these movies that they're making. Like, I am so not part of that world. Okay, I don't even watch the movies because I just have no interest. And so the idea that a comic book could have value to me is preposterous. Okay, however, there are collector editions of these graphic novels that are worth insane amounts of money to the right collector. All right, so you have to ask your client, do you collect anything? So common examples are antiques, art, coins, stamps, comic books, guns, things with value, sometimes that are worth hundreds of thousands of dollars for like a middle class person, and they've got like $200,000 stamp or comic book or gun collection. Right? It's not super common, but it's not uncommon either. The other thing is your clients may have intangibles. So, and we live in an era of digital intangibles. There are people, I'm one of them, that I collect, and I do a little tiny bit of trading and a buying and selling of domain names. Okay, I own hundreds of domain names. There are people that we register them, we squat on them, and then hopefully 10 years later, somebody offers us a bunch of money for them. That is a form of intellectual property that, or an intangible property that has value. Okay, valuing those is very difficult. There can also be, mineral rights or oil and gas leases, things of that nature. They're more common in some places of the country than others, but you have to ask your client about those. Next polling question. I think I'm slightly behind on the polls here. So if it's okay with all of you, I'm going to go to, even though technically a 2 CPE hour block would theoretically be ending here at 40 after the hour, I am going to go for the entire hour because I think that the exercise is worth spending a few minutes on, even if I don't give you time to do it yourself. So we will fill that out together. So next polling question is on your screen. I'm curious who's going to win this one. So far, Grant and Coolidge are in the lead. Oh, man. I tried to think of who the most obscure presidents were. All right, 10 more seconds on the poll. 4, 3, 2, 1. And Grant is the winner. That's funny. All right. Let us now look at the single most important section of the entire 433A. This is where the collection financial standards are actually applied. This is also where we get down to the brass tacks. The reason Section 5 is so important, the income and expense table, is this is what determines whether or not your client is eligible for non-collectible status. This is what determines what your client's installment agreement payment is going to be every month. This is what determines what gets multiplied by either 12 or 24 under the offer and compromise formula to go into determining their minimum offer amount, okay? Literally like 90 or 95% of all the resolution options that are available to your client are based on this table, okay? That's how important it is. So this is Section 5. On the left is income, on the right are expenses, and those expense categories should look familiar. We just talked about them within the past hour and a half, okay? But first, real quick, we'll talk about the income. The main thing I want to say about the income side is that your client needs to put on here all income sources that are available to pay household expenses. The taxability of that income is immaterial, does not matter, okay? So too many practitioners, when they start getting into resolution, they start thinking, you know, they keep their tax preparer hat on. You got to take that hat off, set it aside, and you need to disregard in every way, shape, and form the income taxability of money coming into the household. If there's money coming in, it needs to be listed here on the Form 433A, okay? Pure and simple. So that includes child support. You know, child support ain't taxable, but it needs to be listed here. You know, that disability income, well, it's not taxable, last I checked, but that needs to be listed here, okay? Non-taxable VA benefits, well, it's not taxable, but it's got to go on here, okay? So all sources of income coming in need to be listed on the left-hand side of this form. If it's cash available to pay living expenses for the household, it's got to go on there. Then on the right-hand side are all those expense items that we already talked about. So we're going to do the exercise here in a second. We'll walk through it together. For your clients that are self-employed, you'll notice that Form 433A has a self-employed section. So complete Section 6 to include all that business information, including assets. And then there's a Section 7 that basically looks like a profit and loss statement, kind of, or kind of looks like a Schedule C, right? Here is my trick for you on this. I have never shall I ever completed this page of the form. Never done it, never will, okay? Instead, do the books, create a P&L, balance sheet, depreciation report, and attach those to the 433A, okay? Not only does the IRM permit this, but it demonstrates to the IRS that you and the client are taking steps to resolve the root cause of the problem. The root cause of the problem for most self-employed people is that they just keep crappy records, okay? And that's why they have a tax debt. That's why they're not paying their estimates, because they just don't know how much to pay because they don't keep good records, all right? So by creating that P&L, getting that record keeping caught up and maintained, you're demonstrating the pathway to resolution and creating a good little taxpayer, okay? And that's what the IRS wants. They want good little taxpayers, okay? So I have never, ever completed this page of the 433, just put together a P&L, okay? So we'll do the exercise here in a second, but before we do that, quick conclusion here. Understanding the collection financial standards is important to properly represent clients. It is not uncommon. It is very, very, very common for people to email me and say, hey, I've got this blah, 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 and then they write a 5-page explanation of their client situation, and they're like, where do I start? I don't know where to start with the case. What do I do first? Okay. The answer to that question doesn't require sending me the 5-page explanation. The place that you start every single time with every single collections case is always the same, identical, without exception. There is no special circumstance. It does not exist, okay? You always get paid, okay? Get paid first, get your power of attorney, and once you have your power of attorney, you pull transcripts, and you do a 433, okay? A or B, depending on business or individual, okay? That's where you start. Everything starts with the financials, okay? So if you're ever lost of where do I start with this case, okay, and it's an individual or a business case, start with the Form 433 A or B as is appropriate, okay? Without fail, there is no other answer, okay? Always start with the 433. If it's an individual tax debt, start with the 433A because it will tell you, the math will tell you what resolution options are available to the client, okay? Because, and we'll talk about this here in the exercise real quick, briefly, but this line 50, if this is a negative number, they're probably a CNC candidate, okay? If this is a positive number, if there's money left over, they're probably going to be on a payment plan, okay? If this number is 0 or negative, and the taxpayer also has no assets, then they might be an offer candidate, okay? But this table right here, the income and expense table, this tells you the resolution option that your client is most likely a candidate for, okay? That's why it is so important. Again, if you get nothing else out of this class, that's a huge takeaway. Proper completion of the Form 433 and inclusion of necessary documentation can accelerate the resolution time frame, you know, as long as IRS personnel are available, obviously. That's been an issue lately, but that's something that we can't necessarily control. Proper 433 documentation is often the most difficult thing to obtain from the client. And so here is my practice management analogy that I'll give you that you can steal and use with your clients. What I always explain to my clients, they're like, I don't want to give all this information to the IRS. You know, I don't want them to know where I bank. And, you know, I shouldn't have to give the IRS, you know, copies of my vehicle registration and my utility bills, rah, 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 rah. Okay. Here's the way I explain it. Okay. What the taxpayer did is they took an unauthorized loan from the federal government. What we are doing is a loan application to determine how we're going to pay that loan back. Okay? Whenever a client is moaning and groaning and complaining about my request for financial information and why they have to do it, and I explain that loan analogy, I have never had a client not understand it. They may not, they still aren't going to like it, okay? But at least we go from griping without understanding to griping with understanding, okay? You're still going to have the griping, but it helps the case to have the understanding, okay? And I've never had a client not understand that. And so that's why I use a mortgage loan analogy. to them. Even when not required, as in streamlined cases, and that's something that we'll talk about in an installment agreement class, completing at least a rough draft 433, even if you know that the client is already going to be eligible for expanded or streamlined IA criteria, and so you don't have to produce financials, guess what? Still do a mock draft 433, especially the Section 5 income and expense table, okay? Because if you call ACS in particular, all right, and you say, oh, my client's eligible for a streamlined installment agreement, just give me the IA, okay? Those people have a script. And if you try to force them off their script, they're going to panic and their head's going to explode, all right? They have their script, and then they need to go through their script. And their script has these financial questions about income and expenses, okay? This is a pick your battles kind of thing. Let them read their script. If you have prepared a rough income and expense table ahead of time, you will be able to answer their stupid questions, even though the IRM says that you don't have to. Just answer their stupid questions. You'll be prepared for it, and you'll be off the phone in 15 minutes, okay? You know, after waiting on hold for 3 hours. Play the game, play ball, and just get through it, okay? Larry, the 433B is the collection information statement for businesses. It is very, very similar to the A, except obviously those expense categories we talked about today do not apply, okay? But still do the 433B, have that P&L, and so that you can have the conversation, all right? But start with the financials. Most businesses are going to come to you with a shoebox or Apple box or filing cabinet full of junk, and then you have to turn that junk into a P&L. All right, so get paid, convert that junk into a P&L, and then once you have that, then you can have the conversation with the IRS about the business. But yeah, but the B is just the business version of the A. Okay, and yeah, Seth, sometimes you're going to have to do both an A and a B. And if you have to do both, then you do both, okay? That is not uncommon. All right, so can I rush through this in 8 minutes? I'm going to skip this part and jump straight to the expenses. So when we do this in a live class, we take about half an hour or so to have everybody work on the exercise and fill out the income and expense table based on the expense information that you see in front of you. That's what we do in a live seminar. Obviously not really doable on a webinar format. And so what I guess I'll do, just in the interest of time and the webinar format, I will put this up on the screen. Where is there we go. All right, so the purpose of the exercise is to take what we already went through in this class and to apply each of the expenses that you see listed to, you know what, let me do the last poll first for those of you that just need to get out of here. I may go over the top of the hour by a few minutes. We're not going to talk about it, but Form 433H is something that you should read. It's there in the handouts, instruction forum available on the IRS.gov, obviously. What this does is it combines the Form 9465 request for installment agreement with the 433F, which is the short form version of the 433A, and combined it all together into the 433H, which it's my understanding that ACS personnel have finally At all the call centers, they have finally all been trained on the H, so you should no longer have questions about what the 433H is, and all the call centers at the IRS should now be using it. It is now the new standard. Hopefully that is true in practicality, in practice. But it is supposed to be a simplified single form that combines the IA with the financial information to make it all easier for ACS personnel. Okay, that's what the 433H is. All right, back to this. So the purpose of the exercise is to take the expense items that you see here and shove them into the appropriate expense category. And then it leads to a whole fun conversation about how certain items are treated. So this is not uncommon to what a client is going to give you. Okay, they're either going to give you something with a bunch of numbers scribbled on it that is labeled, or they're going to give you, yeah, here's my bank and credit card statements for the past 2 months. You asked for them, here you go. All right, and then you're going to have to sift through those and categorize them, and then you're going to come up with something that is a summation like this. All right, and so after you comb through bank statements, credit card statements, you create a summation. Then you need to shove these numbers into the appropriate categories on the 433A grid. Okay, and again, when we spend the time in a live class talking about this, it leads to some fun conversations. So in the scenario, it is a single parent and his son living in an apartment in Orlando, Florida. The father is a real estate agent. The mother ran away to join the circus. His average commission averaged out, net of Schedule C expenses is $34.50 a month. Okay, that's the way the scenario is presented. And then we have a conversation. Okay, copay for doctor visit, $25 a month. Where does that go? Well, that is an I don't know if I can fit this on the screen. That is an out-of-pocket healthcare cost. Okay, but remember we talked earlier, the out-of-pocket healthcare cost is the taxpayer can claim the full amount of the standard without the IRS questioning it. And so are we stuck with the $25 a month for the copay plus the $10 a month for the prescription? That's only $35. Is it all we're stuck with claiming? No, it's not. And the reason is, and I'll put this up on the screen so you can see it, is because the IRS standard is $55 a month per person under the age of 65. And so we got a 45-year-old and a 13-year-old. So that's two people times 55. That is 110 a month. And so the taxpayer, they're actually paying $35 a month in the example, but they're able to claim 110 a month because that's what the IRS allows. Okay. An oil change, that's a vehicle operating expense. A haircut, that is actually, let's do this. So where does a haircut fall? So out of the expense categories we talked about, what's a haircut? Where does a hair, type this into the question box. Where does a haircut go? That's an expensive haircut in my world. All right, haircut is a personal care item. It goes into the food, clothing, and miscellaneous box, okay? So if we go here and we add up all the other things that go into food, clothing, and miscellaneous, groceries, some or all of the restaurant expense, that's a interesting side conversation we can have with the client. The gym membership goes into food, clothing, miscellaneous. Charitable contributions go into the food, clothing, miscellaneous. Okay, we add those up, and we're going to get a number. But we have a conversation. Doesn't really matter what our number is, because the number that we actually add up, I think it adds up to like $750 or $800 if you actually go through it. But let's see, two persons, lump sum national standard is $1,288. And so over here, we get to put 1288, okay? That's what we get to put on the 433A. Again, even though if you actually add up what's here in the example, it's only like $800, okay? But because the food, clothing, and miscellaneous is, you get to claim all of it regardless, then we get